Real estate as a sector has been under pressure since the US Federal Reserve began hiking rates in 2022. Prices across listed REITs have dropped nearly 18% from their peak, and investors have mostly moved towards safer assets like treasuries. But here's the twist. Within that same market, a handful of real estate stocks are quietly setting up for double-digit returns by 2026. They are companies built on stable cash flows, rising housing demand, and exposure to structural trends like AI infrastructure. Analysts expect that at least 5 US real estate names spanning industrial, commercial, residential, and home building sectors to deliver 12% or higher annual returns over the next 2 years. We are focused on three filters: financial strength, long term growth catalyst, and proven upside. Each company shows strong balance sheets, steady dividends, and exposure to themes like e commerce, data growth, and the housing shortage. Together, they represent the key pillars of the market, which is logistics, retail, data centers, apartments, and new homes. After 2 years of tightening, inflation is easing, and the Fed's 2025 rate cuts have become a turning point. Lower borrowing costs typically lift REIT valuations, leading to reducing financing pressure and make demand yields more appealing versus bonds. The shift alone can reprice the entire sector. Now, what makes 2026 stand out is that every subsector has its own demand engine. Warehouses thrive on e-commerce and supply chain redesigns. Data centers surge with AI and cloud demand. Apartments tightens as the new supply falls. And the home builders prepare for a rebound as the mortgage rates cool down. Now, together, these five companies create a 360-degree view of the real estate's comeback, from the logistics that move goods to the homes and digital networks that power the next economic cycle. Let's start with the one that quite literally moves the world's goods: Prologis. First on the list is Prologis, the world's largest industrial real estate investment trust. It owns over 5,900 warehouses and logistics facilities, serving more than 6,500 tenants across major trade corridors in the US, Europe, and Asia. Now, Prologis is a quiet backbone of the global commerce world. Every time an online order is shipped, chances are it passed through one of their properties. The surge in e-commerce, along with companies reconfiguring their supply chains closer to home, has created record demand for modern warehouse space. In the third quarter of 2024, Prologis reported that rent spreads on new leases were up 67%, a clear indicator of its pricing power. Occupancy level remains high, and the company's balance sheet gives it room to expand even during volatile markets. But beyond the traditional logistics story, Prologis is now moving into data centers, positioning itself to serve the AI computing infrastructure boom. If interest rates start easing, the compression in cap rates could further lift industrial property valuations. Combine that with solid rent growth and new developmental projects, and Prologis now stand out as a REIT capable of delivering double-digit total returns by 2026. Now, one thing to watch though, industrial REITs are sensitive to global trade cycles. Any slowdown in manufacturing or a prolonged period of weak consumer demand could temporarily weigh in on the occupancy of the rent growth. Now, the next stock on the list is Realty Income, better known as the monthly dividend company. Now, Realty Income owns more than 15,600 single-tenant commercial properties spread across US and Europe. Now, what makes it special though is it's the structure of its leases, because most are long-term triple net agreements, which means tenants handle property expenses like taxes and maintenance. That creates steady, predictable cash flows for shareholders. Around 73% of Realty Income's rent comes from defensive retail sectors such as grocery stores, pharmacies, and convenience chains. Businesses that tend to perform well regardless of economic cycles. Now, this defensive mix is one reason why the company has maintained an investment-grade balance sheet and a 30-year streak of rising dividends. At current levels, Realty Income offers a dividend yield of about 5.6% paid monthly, and analysts expect moderate price recovery as interest rates decline. Since its business model behaves much like a bond falling, treasury yields makes its dividend more attractive, which can push the share price higher. The company has also been expanding through strategic acquisitions, adding new property types like warehouses and entertainment spaces to diversify its portfolio. Added all up, a stable yield of around 5 to 6%, a potential for share price appreciation, and one of the strongest payout record in the REIT world. And Realty Income is well positioned for total returns north of 12% by 2026. The key risk here is the interest rate sensitivity. If rates remain elevated for longer than expected, Bond-like REITs such as Realty Income may underperform in the short term. But with a long history of resilience and consistent cash flow, it remains a cornerstone pick for income-focused investors. Now, the third stock on the list is Equinix, the world's leading data center real estate investment trust. Equinix operates as a global network of interconnected data centers serving more than 10,000 customers, including major cloud providers, telecom companies, and large enterprises. Think of it as the physical backbone of the internet, the infrastructure that allows every cloud service, AI model, and streaming platform to function seamlessly. Even as higher interest rates pressure real estate valuations in 2024, Equinix continued to grow both revenue and adjusted funds from operations. Most of its new capacity is already pre-leased to hyperscale clients, which means strong visibility into future cash flows. The big driver here is artificial intelligence. AI and cloud computing workloads require enormous power and low latency connections, exactly what Equinix data centers are built for. The company's edge computing strategy also positions it ahead of peers as data processing moves closer to users and devices. Despite a relatively modest dividend yield of around 2%, Equinix compensates with consistent growth. Analysts forecast mid to single digit growth in funds from operations per share through 2025, with acceleration expected in 26 as new data campuses go live. As the AI infrastructure build-out continues, Equinix's global interconnection network could become even more valuable. That combination of earnings expansion and potential multiple re-rating gives it room to deliver 12% or higher total returns over the next 2 years. The main risk, however, is to watch is the valuation. Equinix trades at a premium compared to traditional REITs. If tech segment cools or capital costs stay high, short-term volatility could rise. But for long-term investors, it remains one of the most compelling ways to gain exposure to real estate in the digital age. The fourth company on the list is the AvalonBay Communities, a ticker symbol of AVB, one of the most established apartment real estate investment trusts in the United States. Now, AvalonBay focuses on high-quality multifamily communities in coastal markets, places like California, Washington, D.C., and New York. Where housing supply remains structurally limited, its portfolio targets renters with stable incomes, which keeps occupancy and rent collection rates consistently high. Last year, AvalonBay offered a dividend yield of about 4%, and it's been steadily increasing the developmental activity. In fact, the apartment construction by 50% this year, taking advantage of its lower cost of capital compared to smaller developers. Now, what really strengthens the outlook is the supply-demand imbalance. Home ownership affordability is near record lows, which is pushing more people into the rental market. At the same time, new apartment supply is set to drop sharply. By 2026, AvalonBay expects new deliveries to fall just 0.8% of existing stock, the lowest level in over a decade. That means less competition, higher renter growth, and improving occupancy rates for established landlords. The company expects its developmental income to rise significantly through 26 and 27 as new projects begin to lease. Analysts project mid to single digit growth in adjusted funds from operations, and Mizuho Securities recently named AvalonBay its top apartment REIT pick going into the new year. With that mix of reliable dividend, low new supply, and increasing developmental returns, AvalonBay is well positioned for total returns around or above 12% in 2026. The main risk to monitor here would be the exposure to regional economies. Coastal markets are high-cost areas, and any slowdown in job growth could pressure rent renewals, but AvalonBay's prime locations and strong balance sheet makes it one of the most defensive plays in the residential real estate segment. Now, the fifth stock and the last stock rounding up on our list is the PulteGroup, one of those America's largest home builders and a pure play on the country's housing shortage. While rising mortgage rates cooled home sales last year, PulteGroup continued to deliver strong performance. It closed more than 23,000 homes in its latest quarter, exceeded earnings guidance, and maintained one of the highest profitability metrics in the industry with a return on equity around 27%. The company's balance sheet remains robust, allowing it to repurchase shares and maintain dividends even in a slow market. Analysts from major banks, including Bank of America and UBS, recently raised their target prices between $140 and $150 per share, suggesting roughly 15 to 20% upside from current levels. Now, what makes PulteGroup interesting is the long-term shift in the US housing dynamic. There's a nationwide shortage of single-family homes, and when interest rates eventually decline, pent-up demand could release quickly. Now, Pulte's efficient scale and strong land supply puts it in a position to capitalize on that recovery faster than smaller builders. Pulte's lean operations mean it still generates solid cash flows, fund buybacks, and sustains its dividend. With the stock trading at a relatively low price to earnings ratio, it doesn't need a housing boom to create shareholder value, just a mild improvement in affordability. Analysts expect US homebuilders to be re-rated at a higher valuation multiples as investors recognize their operational discipline and stronger margins compared to the pre-pandemic era. For PulteGroup, that combination of profitability, valuation support, and demand recovery makes double-digit total returns by 2026 a realistic target. The primary risk, however, although lies in the macro uncertainty. If mortgage rates stay elevated or economic growth weakens, buyer sentiment could remain cautious, but structurally, Pulte's fundamentals and balance sheet strength makes it one of the best positioned developers heading into the next cycle. Conclusion here is that when you look at these 5 companies together, a clear pattern appears. They cover every corner of real estate from warehouses, retail, data centers, apartments, and homes, and yet all are positioned to benefit from one common shift at the end of the high rate cycle. As borrowing costs ease, property values recover, REITs attract investors' gain, and income assets start to outperform. Each company stands to gain, built but for different reasons. Prologis and Equinix are tied to the digital economy. One moves goods, the other moves data. Realty Income delivers reliable monthly cash flow from essential retail, and the AvalonBay rides the housing shortage in major cities. And the PulteGroup is ready to capture pent-up homebuyer demand once mortgage rates fall. Together, they form a balanced real estate portfolio, blending yield, growth, and stability. When one segment slows, another accelerates. That's the power of diversification across real estate cycles. And the key lesson is that real estate rewards consistency, not speed. The best REITs and builders thrive because they generate steady cash flow in every environment. Dividends, rent growth, and property appreciations compound quietly while others chase volatility. A 12% annual return may not sound flashy, but in real estate, it comes with real assets, stable income, and resilience. When rates normalize, these steady performance often turn into the surprise growth stories. So instead of timing the bottom, focus on quality, balance sheet strength, and long-term demand. Patience often delivers the most reliable returns. If this breakdown helped you to see the logic behind numbers, do subscribe to appreciate. Each week we simplify complex markets and highlight the trends shaping smarter investing in the global world. Thanks for watching and do subscribe to the channel.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.